Zscaler is a hypergrowth company that has absolutely crushed the market since it came public. However, this company's stock has fallen more than 40% since its 2021 highs. Is right now a good time to pick up shares? Here's everything you need to know about this business. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to StockCard.io for sponsoring today's video.
Brian, Zscaler is currently a $28 billion company that trades under the ticker symbol ZS.
Zscaler's mission statement is to make the cloud a safe place to do business and enjoyable for users. While it could be simplified a little bit, there's a lot to like about this mission statement.
So what does Zscaler do? This is a security as a service company that delivers cloud solutions and is primarily focused on large enterprise customers.
Now, Zscaler has a few products, but there are two that investors really need to focus on. The first is called Zscaler Internet Access, or ZIA. This is Zscaler's product that securely connects users to externally managed applications and websites.
The second product is Zscaler Private Access. It's much like the first tool, only here it's connecting you to internally managed applications or websites, usually for the company you're working for. Cybersecurity can be difficult to understand, so here's how to help you wrap your head around it. Imagine that Zscaler is security at an international airport. It's going to stop everyone at security, check their ID, analyze their threat, go through their luggage, and then allow them to proceed, but only to the location that they're supposed to go to. That's what Zscaler does to help ensure that you arrive at your destination securely.
Now, when it comes to assessing complex businesses like this, there are two shortcuts that we think investors can use. The first is to just watch revenue growth and customer growth. If both of those are rapidly outpacing the market, you've probably got a good company on your hand. The second thing that you can use is third-party validation, such as Gartner's Magic Quadrant. On that front, Zscaler has clearly been identified as a leader in its category. So investors should feel good about this company being the top dog in its space.
Now, as we've already said, this company functions as a security as a service provider, and it has very good dollar net retention rates of over 125%.
Now, because it is in blitzscaling mode, the company's customer acquisition costs are very high. Spending on sales and marketing is large and has grown rapidly. Over time, this figure should come down, but for right now, it's something for investors to watch.
In this day and age, having your cybersecurity taken care of is of the utmost importance, so we believe this is a recession-proof business.
And because it's a subscription product, nearly all of the company's revenue is recurring in nature.
Now, Zscaler was the first company to deliver these solutions via the cloud instead of at data centers. It believes that first mover advantage has allowed it to have AI that can detect intrusions better than anyone else. We give it credit for a low network effect because of that.
Like many as-a-service companies, we think this company's primary moat comes from switching costs. Once you get set up and running on Zscaler, it becomes onerous to switch to a different provider.
We also think the company deserves some credit for its brand. It has a net promoter score of 70 and calls out the competition as having an average of around 30. It also has a number of patents on hand to help protect its business model.
Finally, when you look at this company's customer growth, it is clear as day that the company's moat is expanding over time.
When we look at revenue growth over the last 2.5 years, it has been spectacular, growing at 58% per year.
When we look at gross margin, it's extremely impressive. This company's gross margin came in at 80.5% over the last 6 months.
However, when we look at net income, it's actually going in the wrong direction. That's largely because of stock-based compensation and amortization and depreciation on the servers and data centers that it co-locates.
However, free cash flow is rapidly trending in the right direction. If you're confused how net income and free cash flow could be heading in opposite directions, click the video link you see on your screen.
Zscaler's balance sheet is in strong condition with $1.6 billion in cash and about $900 million in debt. Most of that is convertible and might actually lead to dilution in the future instead of needing to be paid back.
Now, returns on capital for this company are currently negative. That's because GAAP net income is negative. Over time, these numbers should turn positive and likely to be very high.
When we evaluate skin in the game, we love what we see here. Jay Chandri is a very accomplished entrepreneur who started a number of companies and is still on board as the company's CEO today.
When we look at employee ratings, they seem to absolutely love working for the CEO and for the company itself.
And if we're measuring financial skin in the game, Chandri has a ton. He primarily owns over 20% of the company, making him a multi-billionaire.
Turning to optionality, Zscaler has rolled out new products and services that open up new revenue opportunities, but we don't think it's anywhere near as extreme as we've seen with companies like CrowdStrike, for example.
When we look at operating leverage, it's no surprise that we're all the way over on the left. There's tons of room for it to improve. However, a lot of that has to do with stock-based compensation and depreciation. If we're talking about adjusted earnings or free cash flow, there's still room to improve, but less.
Now, the market market for cybersecurity tools is massive and growing very, very quickly. Currently, Zscaler believes that its total addressable market opportunity is $72 billion, of which it's captured about 1%.
And the vast majority of the growth that we've seen so far has been organic. The company hasn't had to rely on acquisitions to boost its top line.
Now, Zscaler has been a monster long term winner. This stock is more than a 10 bagger since coming public just a few years ago, and that's after falling more than 40% recently.
At the same time, it has both a long and a short term history of blowing past both analyst expectations and the own forecasts that they lay out.
Now, Zscaler is still in rapid growth mode. For that reason, it's not focused on returning capital to shareholders at all.
Now, when we look at risk, competition is the biggest one. There are tons of providers in the cybersecurity realm. The company calls out Cisco, Checkpoint, Palo Alto Networks as some of those that could eat into their business.
Another risk to be aware of is this company does dole out quite a bit of stock based compensation to its employees. That makes the dilution worth keeping an eye on.
Beyond that, we do want to call out one outside force that could have an immediate impact on the company and its stock, and that's if Zscaler itself gets hacked. If that happens, it would be very difficult for customers to trust their solutions and could lead to very rapid declines in the business. And it's also worth calling out that this is still an expensive stock despite falling over 40%. It trades for 36 times sales and over 200 times forward adjusted earnings.
Given those valuation numbers, if there's any slip up in the company's growth rate, look out below for shareholders. So, what should investors keep their eye on moving forward? First, keep an eye on billings. This is contracted business that hasn't yet turned into revenue. Billings have grown at more than 55% over the last 3 years. That's an extremely strong rate that we want to see keep high.
Second, we've called out that Zscaler is really focused on large enterprise customers. These are customers that pay them over $100,000 a year. You'll want to see that number continue to grow as they have still captured such a small portion of their total addressable market.
Third, keep an eye on spending on sales and marketing and customer acquisition costs. If the company can continue to improve this number over time, it should lead to scale, which will make its net income soar. For me, this company got an 80. There is so much that I like about this business.
And on my framework, it scored equally as well, knocking on the door of being anti-fragile with an 11.75. It makes me wonder, why don't I own this stock?
I've thought that same thing because, like you, I don't own it either. However, we both just made our bullish call, so we're going to head on over to stockcard.io to hold ourselves accountable. All right, so we're in StockCard, we're in the anti-fragile portfolio, and we are going to add it. So the ticker symbol here is ZS. We're going to do a buy decision. We're recording this on Monday, March 14th. This is a $200 stock, so we're going to buy 5. And the score was 11.75. Then I'm going to head it over to the Brian Feroldi quality checklist. We're going to place a new order, and we're going to do the exact same thing.
While Brian does that, we want to remind folks to head on over to stockcard.io. We currently have a contest called Beat the Brian's taking place. You can enter for free, and you pick 5 stocks you think will do the best between now and the end of 2022. The winner gets $1,000, and you are pretty much guaranteed to be starting ahead of us because we are down big so far this year.
Well, there you have it. Both of us do not own shares of Zscaler, but we think it's a very high quality business and could add this stock to our portfolios soon. Brian's out.